Uses of whole life insurance. As with any kind of life insurance, a whole life insurance policy gives individuals and their families financial security against the loss of a breadwinner. For families that rely on the income of a single person, a whole life policy can provide financial security against the sudden loss of an income provider. But unlike term life, whole life can also be used as an investment. Once the cash value has grown big enough, you may be able to withdraw or borrow from it to pay for large purchases such as home. Some people also use whole life cash value to supplement their income in retirement when markets are low. Whole life insurance is also useful for businesses as a contingency plan for a loss of a key employee or partner. If a key employee passes away, a whole life policy can provide a financial offset to the loss of their skills or expertise. If the deceased is part owner of the company, a whole life policy can provide the remaining owners with enough capital to buy out of the deceased partner share of the business. Type of whole life insurance. There are several main types of whole life insurance categories based on how premium are paid. Level payments. First, premium remain unchanged throughout the duration of the policy. This is the most common type of payment plan. Single premium. The insured pays a one-time large premium which funds the policy for life. But this type of policy is almost always a modified endowment contract which has tax consequences. Limited payment. As the name suggests, you pay a limited number of payments. Premium will be higher than they would be in a level payment situation, but you only pay them for a certain number of years. Modified whole life insurance, the opposite of a limited payment policy. This type of whole life insurance offers lower premiums than a standard policy in the first 2 or 3 years and higher than standard premium in the later years. It is more expensive in the long run. Whole life insurance policies are further distinguished as a participating and non-participating plans. With a non-participating policy, any excess of premiums over payouts becomes profits for the insurer. However, the insurer also assumes the risk of losing money. With a participating policy, any excess of premium is distributed to the insured as a dividend. The dividend can then be used to make payments or increase one's policy coverage limits. However, dividends are not granted and often vary each year as they are primarily based on the company's financial performance. Whole life insurance versus term life insurance. Whole life insurance is similar to term life insurance in that both types of policy offer a payout upon the death of the insured. However, there are important differences. While whole life insurance offers a guaranteed death benefit for the entire lifetime of the insured, a term policy only pays out if the insured dies within a certain time frame, usually 10, 20 or 30 years. For more videos, please like and subscribe my channel. Thank you friends.